Imagine you wake up one morning and your grocery bill has doubled. Not gradually, overnight. The bread you bought last week for 40 rupees now costs 80. The cooking oil you've been buying your whole life is suddenly out of reach. You check the news and economists are saying inflation is high. The government is saying they're working on it. And everyone around you is nodding along, accepting this explanation the way you accept bad weather. But here's the thing nobody is saying out loud. This isn't inflation. Not really. What you're watching is something older, more dangerous, and almost always misdiagnosed, even by the people whose job it is to diagnose it. This is a currency crisis wearing inflation's clothes. Let's be precise about what inflation actually is, because the word gets used so loosely it's almost lost its meaning. Inflation is when the general price level of goods and services rises over time. It happens for many reasons: too much money chasing too few goods, supply chain disruptions, rising wages, high energy costs. In a normal inflationary environment, prices rise slowly, somewhat predictably, and across a wide basket of goods. Central banks raise interest rates. Things cool down. Life goes on. A currency crisis is different. And the difference matters enormously. A currency crisis happens when a country's own currency loses value rapidly against other currencies, specifically against currencies used in global trade, like the US dollar. When that happens, everything a country imports becomes immediately more expensive. And in most developing economies, that's a lot of things. Energy, medicines, electronics, raw materials, food. So prices rise. Sharply. Suddenly. And from the outside, and often from the inside, it looks exactly like inflation. But the cause is completely different. And if you treat the wrong disease, you make the patient sicker. Here's how it actually unfolds. A country runs a persistent trade deficit. It imports more than it exports. To pay for those imports, it needs foreign currency, mostly dollars. Over time, this drains its foreign exchange reserves. Investors start to notice. They pull money out of the country. The currency weakens. The government, trying to defend the currency, spends more reserves. Which weakens confidence further. Which accelerates the outflow. Which weakens the currency more. This is a feedback loop. And once it picks up speed, it's very difficult to stop from the inside. Now the currency has dropped 30, 40, 50% against the dollar. Suddenly every import costs 50% more in local terms. Fuel prices spike. Power costs rise. Factories that depend on imported inputs slow down or shut. Unemployment rises. And the average person standing in the market watching prices double in 6 months is told, this is inflation. We are working on it. No. This is the price of a collapsing exchange rate showing up in your daily life. The confusion isn't accidental. Calling it inflation is politically safer. Inflation implies a domestic problem with a domestic solution. Raise rates, cut spending, tighten money supply. It keeps the conversation inside the country. It frames the crisis as a technocratic challenge, manageable, temporary. Calling it a currency crisis is something else entirely. It implies external vulnerability. It raises questions about foreign debt, reserve management, capital flight. It invites scrutiny of decisions made years earlier, the loans taken in dollars, the reserves spent defending an overvalued exchange rate, the economic model built on imports rather than production. So governments call it inflation. Central banks raise interest rates, which slows the economy without actually solving the fundamental problem. The currency is still weak, the reserves are still thin, and the debt is still denominated in someone else's money. Sri Lanka in 2022. Pakistan across multiple cycles. Argentina, almost chronically. Turkey in 2021 and 2022. Each case had its own texture and its own political history. But the structural story was similar. Currency under pressure. Reserves falling. Import costs spiraling. Ordinary people watching their purchasing power evaporate, and being told it was inflation. There's a particularly cruel irony at the center of all this. When a currency crisis is misdiagnosed as inflation, the conventional response is to raise interest rates. Higher rates attract foreign capital, the theory goes. Investors chase yield. Money flows in. Currency stabilizes. Sometimes it works. Briefly. But high interest rates also crush domestic borrowing. Businesses can't access credit. Investment falls. Growth slows. Tax revenues drop. The government borrows more to cover the gap. Often in foreign currency, because that's what lenders want. Which increases the very foreign currency exposure that made the country vulnerable in the first place. You're treating the symptom with a medicine that worsens the underlying condition. What makes this genuinely difficult, not just politically, but technically, is that currency crises and inflation are not mutually exclusive. They often arrive together, feeding each other in ways that are genuinely hard to untangle. A central bank trying to identify the primary driver of rising prices, in real time, under political pressure, with imperfect data, is not in an enviable position. But that's exactly why the distinction matters. Because the policy response is different. The structural reforms required are different. The conversations that need to happen, about export capacity, reserve management, foreign debt composition, are different. And harder. Much harder than saying, inflation is high, we're raising rates, please be patient. So the next time you hear that a country is experiencing high inflation, it's worth asking a second question. Is the local currency falling at the same time? Because if it is, you might not be looking at an inflation problem at all. You might be watching something more fundamental unraveling, a country's relationship with the global financial system quietly coming apart at the seams. And the people most affected by it will be the last ones told what's actually happening. That's not an accident either.